Today I'm going to talk about why charges on funds are the least important factor in investment performance. Now I know this will be contrary to most people's perception because of course the one certainty with an investment fund is the level of charges. Performance isn't certain, isn't a given, but nonetheless I feel that far too much focus by both the regulators and investors, clients, even advisors themselves is on charges, which I think is at the expense of investment performance, because surely the most important thing to an investor, apart from security and peace of mind with their investments, is to achieve the best possible return net of charges in accordance with that client's attitude to investment risk, the level of risk they're prepared to take, how much they're comfortable with taking in terms of risk. So I found a white paper by a company called United Income, a US company admittedly, who did a lot of research into lots of different fund managers, wealth managers, their different propositions, their investment propositions. As a result of this huge study, they found that charges alone were not the most significant factor in determining the level of investment return. And in fact, they went as far as to state, based on their evidence, that the non-charges factors, they called them, and there was three main ones, these would produce 7 times the increase in wealth that a reduction of 1% a year in charges could make. So in other words, there's far greater potential to get better investment returns by not focusing on the charges, focusing on these other 3 areas. Let me tell you what they were. One of them was taxation. Another one was maximising social security benefits. And the third and very critical factor was the asset allocation. In other words, where your money was invested and the importance of investing it correctly based on the client's attitude to investment risk. They found these 3 factors made the most difference. And when you think about it, it stands to reason. Now, it was a US study, so the emphasis on maximising social security benefits, I'm not sure it's as important in the UK, because when we talk about retirement, we're primarily talking about your state pension. So arguably you could get a state pension forecast, which you can do very easily by doing a search on the internet and just putting in state pension forecast. You may find you haven't got the maximum state pension. You could pay some money to buy some extra years to boost your state pension, that kind of thing. So that is probably quite useful, but maybe not as important as in the US. I don't know how the US system works, quite frankly. But I certainly think taxation's a big issue, because time and time again we come across new clients who haven't previously maximised the tax efficiency of their investments. For example, they haven't put the maximum into ISAs every year. They haven't put the maximum into pensions every year. Notwithstanding the fact not everyone can afford to do that, but they've not put in as much as they could have done. And those kind of tax shelters make a massive difference to your wealth, because of course taxation, income tax, can be a maximum of 45% in the UK. Capital gains tax can be typically up to 20%, 28% if it's residential property. So you can see the impact of taxation is far, far greater than a potential 1% extra charge on funds for investment management. So if you're arguing about whether it's 1% a year or 1.5% or 2% or 0.5%, it really isn't that significant when you can be looking at tax savings of anything up to 45%. That can make a massive difference to the investment returns you can make. And in fact, with some clever tax planning, the effective tax relief you get can be far greater than that even. But that's for another video, another day. And the third factor, which I think is critically important, is the asset allocation. In other words, investing in the right place based on that client's attitude to investment risk. You see, it's all very well paying low charges, but if your low charges result in a very low return net of charges, is that really what you want when you could pay a higher charge and get a far higher return net of charge? Let me give you an example. Let's say, for example, you paid a very low charge of 0.5% a year on what's called an index tracker fund or a passive fund. Then let's say your return for the year, you managed to achieve 5% net of charges. Well, that's not too bad. If it's not a great year for stock markets, you might be happy with that. But if alternatively you were paying for superior investment management and you achieved a return of 10% a year net of charges, then wouldn't you be happy to be paying a fee of, say, 1.5% fee? Because remember, what we're talking about is not the level of fees, we're looking at the investment return after deducting fees. And that's the critical point. Would you rather receive 5% a year or 10% net of charges? The fees are higher, 3 times as high, but you really do get what you pay for. And if you pay for superior fund management, you should get higher returns. Now, what I'm not saying is you should go out there, pay that level of fee, 1.5%, and get a return of 5%. Clearly, that wouldn't be a good deal. And that's where either your own research or the advice from a very good financial advisor comes in very handy indeed, because that can help you make all the difference. So remember, those 3 factors, taxation, social security benefits, and asset allocation, will make you 7 times wealthier than just being able to find a 1% a year reduction in charges. That's what creates the wealth, not the charges.